Every day I get asked what stocks should I buy and what are the best sectors to invest in. Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be taking a look at the sectors in the market that are set to rise and where you will find the best stocks for your portfolio. I will also give you my views on the Dow Jones and then get into this week's stocks of interest. First, hit that subscribe button and click the bell on the right of it so you keep up to date with our latest videos. Also remember to tune in to our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. Every day I get questioned by investors, traders and the media about what sectors and stocks to invest in and which ones to avoid. Let's face it, what they really want me to do is share with them where the next big opportunities are coming from so that they can get in early. But it's not quite as simple as that. To understand where the opportunities are coming from, you firstly need to look at the past and how each sector has been unfolding to date. You then need to look into the future and study the metrics that might affect each sector moving forward. Metrics such as interest rates, currency movements, PE and EPS ratios for the short, medium and long term, dividends, and the list goes on. All this can be quite challenging for those new to the market, and so I understand someone wanting me to set them on the right path. In a minute, I will share with you 2 easy ways as to how you can determine for yourself the best sectors to invest in, and I'll give you the sectors I like moving forward. Finding the right sectors is one thing. After you determine that, you then need to find the stocks that suit your portfolio and the analysis starts over again. So how do you make all this easier for yourself? Well, quite simply by learning how to read the charts of the sectors rather than look at all the fundamental metrics. Now, before we look at that, we need to discuss sector investing. In its simplest form, investors just want to own stocks that are rising in value and buy other stocks that will rise. But here is where things start to fall apart, as they start talking about diversification into sectors. For example, investors often believe that stocks in their portfolio should closely represent the sectors so that they have a balanced portfolio. Yet this is not wise if you wish to get good returns. Let's face it, stocks rise and fall, and sectors rise and fall as a result. So in the interest of getting good returns, it makes sense to avoid sectors that are falling in value and only invest in ones that are rising. The table on your screen right now shows the sectors in the Australian market, and they're pretty much the same sectors you will find in any stock market around the world. Stock markets use a standard classification system for stocks called GICS, or Global Industry Classification System. Having this classification system means investors, both professionals and private, can easily understand what industry sector a stock is in. In the table you can see the 2018 growth for each sector along with the year-to-date figure in 2019. Now in 2018 you can see that the biggest loser was the telecom sector, and that was down 25.3%. And the biggest winner was healthcare, rising 17.33%. As money continually moves into and out of sectors, in general we can assume that the best performing sector in one year is unlikely to be the best performer the next. This is the same for the worst performer each year. Now looking back at the table again, you'll see that the telecom sector has reversed its fortunes from 2018 and risen 20.23% in 2019, whilst healthcare has only increased 6.62%. Now if we look at the next best and worst sectors, you'll see a similar pattern as consumer discretionary was up around 9% in 2018, only to fall slightly into the negative so far in 2019. Now financials was down 14.78% in 2018, only to turn and rise in 2019 to now be up 3.68%. Whilst this is just a small snapshot in time and it shows a definite pattern, this example is a little oversimplified. Sectors and stocks rise and fall at constantly changing speeds, and sometimes they rise or fall over multiple years. And so whilst this theory is a good guide, it's not a hard and fast rule and should never be treated as a hard and fast rule. That said, the pattern this example reveals is that by having a contrarian view, you are more likely to select the next best sector. The exciting part is that once you identify the sector, you can also bring this exact same theory into stocks to find the ones that are likely to rise in the near future. Now let us look at a chart to determine the most likely best performing sectors moving forward. On your screen right now is what I like to call a spaghetti chart with all the same sectors listed as before. Now the lines are color coded so you can easily recognize each sector. For example, the text XIJ is marked at the top of the chart in an olive brown color, and this relates to the line of the same color immediately on the left of the text. So how do we read this chart? Quite simply, we're just looking for the sectors where the line is moving up and down. The XIJ, XMJ and XHJ are all moving up at different speeds, which is indicated by the steepness of the lines. The XUJ, XDJ, XFJ are all currently moving down, suggesting they are falling. And again, the angle reflects the speed of the fall. Now the trick is to watch the sectors that are falling and wait for their line to show signs that it is turning to rise, and then this sector you could look to invest in for the future. For example, you will see the XEJ has recently turned up in price, and so I would look at the energy sector for stocks that have also just started to rise. Now the other way you can look at this is the steepness of the line. If a line is only rising slowly and then starts to increase its speed, you know the stocks in that sector are starting to move faster and so may represent a good opportunity to buy. So what sectors do I see that will perform well for the remainder of 2019? Well, from the table and chart we've just discussed, I like energy, financials, telecom, as they will most likely turn around to rise, and I also think materials and information technology have a little further to go. I also think that healthcare, consumer discretionary and consumer staples will remain slow for a while longer. So there you have it. I've shown you two really simple ways to assess the sectors for yourself, one on a spreadsheet and one on line charts. Now have a go at looking at the stocks in these sectors that we chose to see if you can find some that will outperform in the second half of 2019. Let's go and take a look at the market and then some of the stocks of interest for this week.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Okay, everybody, wasn't the last week quite interesting time on the marketplace, and the Dow Jones really did take off a little bit, and they say a week can be a long time in the market, and certainly the case with what happened on the Dow there. I'm actually recording this on the Sunday, not on the Monday that I normally would do, so that's why you're not seeing me on camera at this point in time, but I'm actually I'm in Sydney doing some TV interviews from that point of view, but it doesn't change my thoughts. It's got all the data from the Friday, but if you look at the Dow Jones, you had this big mess across here in terms of, if I get there, and right now you can see we've had one close above that level, which is September last year, from January 2018. So September last year was the only time in the last 12 months that the market closed above that range of 226,149, although it did trade above it a few times through there, but quickly reversed it. So this is a really important month, this point in time, where we opened here at 26,075, and currently we're closing at 26,412. So if it continues to stay up and this keeps trading up here, this is really augurs well for the Dow, because that high close, I remember there's an old saying that the amateurs open the market and the professionals close it, and it is so true. The professionals just wait for what other people are doing and see what's going on and see what momentum's happening and see the volatility, and then make their decisions from there. And the amateurs tend to jump on news or anything that's moving, and rumours, conjectures and hot tips. That's what amateurs tend to do, and they trade in the mornings and they see some volume increase and then they jump on into it. But what we're seeing here is if this can come up. Now we're only roughly halfway, not quite halfway through April, so it'll be interesting to see if it can maintain this momentum. If it does maintain this momentum, and I think there's good news for the Dow, and I think it will augur well for it to go through this previous high here, or previous all-time high, 26,951. Whilst this is the area that's concerned me down into this low here. It didn't really come down enough. I really did want to see it more, and because it's not doing this, then it's upward moved here. I don't think there's going to be too long. I think we're only going to see maybe 4, 6, 8 weeks up before it comes down into a bit more of a major low. And so all it's doing, markets have two big moves in a year, so they move from low to high to low to high to low over a year. So there's sort of two movements. Think of it roughly as an M shape, or M for Mary, M shape. Not that it exactly unfolds that way, but you get the point. There's a low, there's a high, there's a low, there's a high, there's a low. And what you want to see is the second high higher than the first one, and the second low higher than the first one, and the third low, which is the last part of the M, higher again, and that's a nice bull market. And what we're seeing here is this low here from December, which is lower than everything else since back in 2017 August. There we got 21,600, and this one here is 21,712. So we've seen see where there's low to high to low to high to low. So this is interesting because this was higher than this one. So there's your M shape, and it had the big moves up and down. So here we've got to create another M shape. So is this the top of the M going to be like this? Is it going to be higher than this one? If it's not, then the market will fall over. But I'm expecting it to be higher, and then it will come down into a move, then move up into another move, which could be a move like this into the year, and then come back down into eventual low sometime towards the end of the year, which could be sort of September, October. But I think between now and the end of mid-year, we'll make a new all-time high on the Dow. That's really what I'm thinking. So all you need to do now is go down into some of those sectors and look and see what's going on some of those sectors which are running better. I mean, the FANG stocks are looking better. The technology is looking better after being more bearish last year. So there could be some opportunities in those, along with some other areas. Now, I wanted to have a more look at some of those stocks from last week from the lady that I was been chatting through to in California, the lady called Jean, and I did look at ALK, COF, SCHW and PHG for her last week in her portfolio. But I thought I'd bring up a couple more stocks in her portfolio. As I said last week, I was quite, when she showed me her stocks or sent me her stocks, I was expecting a much worse portfolio from normally what I would get from somebody who's been using an advisor, because generally advisors aren't fantastic at picking stocks. It's just because they've got so many other things to do. I mean, advisors are generally paid by the managed or the mutual funds and the industry, and it's always has been working on commissions and people managing funds for individuals or professionals managing funds. So direct share investment is not necessarily their forte and not necessarily what they want to do. And so therefore, as I said, I was a little bit surprised when I did see the portfolio. I thought it was not bad, actually. One of the better ones that I've seen. It wasn't too over-diversified and had some great stocks. One of those great stocks is Costco. I mean, you have a look at this stock, and let's just bring it up. It just looks magic. And I'd be really, really impressed on this sort of stock. But you look at that, and it just trundles along nicely, and I think it's got some more legs into it, although there's a little bit of indecision this month. But if I just use a trend line tool and just look at the momentum of this stock, you can see here, if you look at peaks and troughs through here. You'll see it runs around this grey line and it just moves up and around, and it hit it back through here. It's moved up again. And when it does move away faster, they will come back and correct, but it still does look quite nice, this stock. I mean, after having a fall from September last year, like a lot of stocks did, down September, October, November, December. There was a nice move down in a lot of stocks through this, but has made a new all-time high. Remember, looking back, the Dow hasn't made a new all-time high, but this has, which means that this is in momentum and volatility, this is outperforming the Dow. This stock, so that's a good sign to have. Right now, if I look at this, you see it's open up and closing a bit lower, so it'll be interesting to see if it holds up, or we get 1 or 2 months down and then taking off again. But if I go back to the weekly chart, you'll see it's had 1, 2, 3, 4, 5, 6, 7, 8 weeks up. It's due for 1 or 2 weeks down and then taking off again, so it's just readjusting the momentum. So very good looking stock Costco is. This is EPR Properties. E for Echo, P for Peter, and R for Robert is the stock ticket code, and you can see here if I bring it back, a little bit more volatile than Costco was. You can see very, very big moves on this stock. This is not necessarily a buy and hold stock, and we looked at a couple of those last week for Joan. I mentioned the same thing. It's not necessarily a buy and hold stock. Costco is, because you can see how it unfolds, but this one is not. And if we open that up, you'll see it a little bit better. You can see here how it's had this big move from August 2000 through to February 2007. Beautiful move, but then it lost 90% to 100% of what it made. And it's had this another big move and then another reasonable fall. And these falls, quite big, large falls. So if you had that, nearly 39% fall down into that low in March last year before moving up again to where it is right now. And it's moving up quite nicely right now. But you could have bought this stock way back in 2006 and still bought it at the same price back recently. That's what I'm saying. It's not necessarily a buy and hold stock. Right now, what's it looking like? It is looking more bullish. So it is looking like it will continue on and move through that high. So again, a good looking stock at this particular time. I would have a stop loss on it, an exit strategy on this stock, more so than an advisor portfolio, which is more buy and hold. Advisors generally don't say to exit stocks, but at this point in time it's looking really, really nice, so I'd stay with this. The next one I want to have a look at is Union Pacific. Now I'll just bring that up again. Another big trending stock. Look at that, massive trending stock and looking good. But what it is, it's starting to move a bit more vertical through here, and again, a beautiful, nice trending, more buy and hold stock. So the advisor did really, really well here, although you can see here through here it looks a bit more sideways. But if I take that out of it, you can see it was still quite volatile through here. But it did settle down in the early 2000s and mid 2000s and go into this beautiful trend, and it's looking really, really nice. So I think this is quite sustainable. I would be staying with this stock. Looking at the angle of this, and this is where I often say to people with angles, if I do angles like, well, what's the angle of, give my pointer on it, here we go. If you look at the angle of that move, and then you can look over and just drag it and see what it's doing. You can see here how that angle is a bit faster, so it is moving a little bit faster than what it was in that prior big bull run through here, and that big bull run was faster than these ones. So this one was faster, and then this one's faster again. So you see that acceleration, but eventually, like all acceleration, when something goes really, really fast, it'll start to slow down again for its momentum. But right now I'm not really worried about that. I would be worried if it was going a lot more vertical, but let me do another one of those lines. If I do one more so on this angle, you can see the difference in the angle now, can't you? You can, if I go and put the 2Ds, come on, drag it off. Here we go. You can see the difference in the angles between those two. So it's now running at faster speed than what it was through here. But nothing too much to worry about. So what I would expect is it might continue to move on and then come back a little bit to adjust its momentum. But right now I'd be staying with this stock. The next one is Norfolk Southern Corporation, or N for Nelly, S for Sam, C for Charlie. And again, another beautiful looking stock. So I would suggest, I know Jones mentioned she's got ETS, but I'd say over the past few months, this is going to be starting to more outperform all these stocks that you've got. probably be outperforming a lot of those mutual funds that ETFs and mutual funds. The thing is with mutual funds is they struggle to outperform the market. Active fund managers really struggle to outperform the market. And passive fund managers, and you generally are looking at the research on my book, Accelerate Your Wealth, which you can get at lots of bookstores or on Amazon. Get rid of what am I doing there? It's available on Amazon and it's available in bookstores. You just go in and go to our website, wealthwithin.us. Wealthwithin.us is our website here, and you can see here it moves up around these sorts of lines. So right now I think it's moving beautifully. I think it's a nice looking stock. It is again a nice investing stock. Now I'm not putting really any technical analysis or anything on this. I'm just looking at price pattern and time with my eyes, given that I'm very experienced at doing this, and I don't want to put a lot of price time and work on it because I want to make sure people understand, keeping it simple. So, but you can see here the angle of this trend again. If we're talking about those again, if I put my trend line on here, we see the angle of this trend, just like I was talking about before. You can see here the angle of that move, and if I drag it over here, come on, you can see that how different this angle is. It's moving at a much faster pace, and again it's moving up. These sorts of periods don't last very long. You can't see one here, you can't see one here. You see a little bit of one there around about the same speed as this move, but looking back here, it doesn't move this fast for very long. So I would expect it probably might have another month or so up before it starts to move back down again and come back down. And if I put my little line on it, you'll probably find it'll come back down into this sort of area here. But right now, I'd be staying with this. A really, really good stock. So, as Joan mentioned to me once on one of her emails, she said she was reasonably happy with her advisor, and so she should be. To me, it's not a. Can I say it's not a usual statement somebody says to me? Often people say to me, "Oh, I'm not really happy with my advisor. They're doing this or they're not doing anything. They're very passive there." And I'm always fighting against them in terms of trying to be a bit more active and getting more growth or getting much more into direct shares rather than staying out of some mutual funds and getting into that sort of stuff. So, but right now I think this is looking really, really good. So you're doing really, really well, Joan. I think your portfolio, your direct portfolio should be performing well over the last few months. And my suggestion is probably beating, over the last couple of months, you'll probably be beating your ETFs, because it's always the 80-20 rule. It's 80% of the returns will come from 20% of the stocks, basically. So, and generally those stocks are the ones you would know anyway. They're the top stocks. For example, if you look at the S&P 500 and you had an ETF on the S&P 500, the technology stocks are 25% of that whole index. And if you just purchased the FANG stocks, and yes, they had a downward move of 30, 35 up to 40% last year into the low of last year in December. So they didn't perform very, very well, whereas the ETF itself would have done okay, because it was with the S&P 500, and the S&P 500, whilst it did come back into those times, it probably would have been lessened in terms of the actual pullback, because we saw the S&P 500 didn't pull back 30+%, did it? So, but then when you look on the inverse, is now the FANG stocks are moving a lot faster. Again, they're rising faster, so it'll be outperforming the S&P 500. And if you look at things over 12 months and 2 years and 5 years, you'll actually see the top 10 stocks in any one index will generally be the best performers, because that's why they're the top 10 stocks. And just buying those, you'll do a lot better, which is stuff I talk about in my book, Accelerate Your Wealth. And I talk about the Dow stocks in my Accelerate Your Wealth. I analyze the top 30 or the 30 stocks on the Dow, and I think we made over 400% over 10 years, including the GFC. And worst time in history, or living history, we still made 400%. So with some simple rules. So that's it for me for this week. If you've got any questions or you want me to look at the stocks for you, please shoot them through to us here at Wealth Within. We'd love to help you out and show you what we're thinking of your different stocks and the markets and everything else, and answer your questions. So good luck, good trading. That's it for me. Bye-bye.